Here is an example of a covered call trade that goes well with Zillow. So on August 20th, I bought Zillow. I bought 100 shares of Zillow at around 35.2. So I paid, $3,528 came out of my account on that day. But I immediately sold a call option at a 34 strike. So that means I'm willing to lose my shares at 34. In exchange, I got $257 back. And this call option that I sold had an expiration of September 20th. Now, come September 20th, if we go see where Zillow was trading at September 20th, it was trading at $30. So I bought the stock at 35, but then a month later, the stock is trading at 30. Now, I bought Zillow. The reason I bought Zillow is because of this right here. You can see how hard it dropped. So when I saw this drop, I make the assumption that eventually it's going to come back up. Now, it's not the best way to buy a stock, but I believe that when a stock drops hard, it eventually comes back up if it is a fundamentally good stock. So if the fundamentals haven't changed in the stock and it just drops hard, in my eyes, it becomes attractive. So I bought it at 34. Now, I don't know if it's the lowest point. I'm only making an assumption. I bought it, but because I don't know what's going to happen after, I don't know if it's going to go up. I don't know if it's going to stay at exactly 35. I don't know if it's going to keep going lower. So I sell call options on the stock that I hold for that reason, to collect something from it in case it doesn't do anything and in case it drops. So that's why I sold that call option over here. So come September 20th, Zillow was trading at around 30. Remember, my strike is 34. So as long as Zillow stays below 34, my option will expire worthless and I keep my shares. They don't get taken away from me. If Zillow was trading above $34 come September 20th, then my shares would get taken away at 34, but I wouldn't care because I already made my profit in 1 month. I get my money back and I can use it to do another trade. So September 20th, the stock was trading at 30, so my call option expired worthless. I sold another call option at the same strike price of 34 because I'm okay letting my shares go away at 34, not lower. But this time, because the stock was trading at 30, I wasn't able to collect a lot of premium. So the first time, collected $257. The second time around, I was only able to collect $29 for an option that expires October 25th. Come October 25th, let's see where Zillow was trading at October 25th. So October 25th, Zillow was trading at 33.53. So it was getting close to my strike price of 34. So what I ended up doing is on October 18th, so I didn't wait till October 25th. I ended up buying back the call option here that I sold. Remember, I sold a call option for 29. I ended up buying it back for more, for 37. But in exchange, I sold a new call option expiring November 22nd. I collected $218. So first time collected $257. Second time, $29. Third time, I'll have to combine these two, collected $180. And then come November 15, the stock rallied and is trading way above 34, is trading at around 38. So obviously it's way above my strike price of 34. So I could either add a few choices. If I want to keep the stock, I'll have to buy back the call option and maybe sell another one either at the same strike or at a higher strike. Now, if I do it at a higher strike, I'm not going to be collecting a credit. It'll be for a debit. If I do it at the same strike, it'll be for a credit, but the credit was so small, it wasn't worth keeping the shares and paying interest on the shares. Because it's in my margin account, I'm actually paying interest on these shares. So I decided to just get my money back and sell my shares. So on November 15, I ended up buying back the call option of 34, the call option that I sold for $218 over here at a 34 strike expiring November 22nd. I ended up buying it back for $486, but I sold the Zillow shares for 38.7. I was willing to let it go for 34, but because I was able to buy back the call option, I could then sell the shares at the current market price. But as you could see, if I combine them both, the net result of these two transactions gives me almost the $34 that I was willing to let my shares go. You could see here the sum is $33.84. So it's like I sold it for $33.84 instead of selling it for $34. Obviously, commission is included. And of course, this is 1 week early. I didn't have to wait till November 22nd. I closed it 1 week early, so I saved on interest for a week. So the total profit I made on this Zillow covered call trade is right over here. The sum of all this, $323 US. So this was done, I started this trade August 20th and I got out of it November 15th, about even less. So let's say 3 months. So this is about a $323 profit over a $3,500 invested. So it's about 10% in 3 months. Annualized, that's about 40% per year. So this is an example of a covered call trade that goes well. Now I have my capital back. I can use it towards something else. But this is why I love selling call options, is because I don't have to wait for the stock to do something. Now in this case, it went to 39. I probably would have made more if I just kept the stock at 35 and then sold it at 39, but I don't know that's going to happen. In fact, it dropped all the way. It dropped even lower to 30, even to 29. Based on my personality, I don't like to wait. So I prefer to take action and sell something right away, collect money, even if it ends up being a little bit less than if I had held on to it. But it doesn't mean that if I had held on to the stock alone, that I'm always going to be making more. All right, so if you have any questions on this covered call trade, leave them in the comments section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.